16 of 21 series are aligned with STAGFLATION mild this morning. That is a moderate but meaningful clustering of the math around a single configuration. The current macro regime is STAGFLATION mild, with a confirmation score of 16 out of 21. In the engine's terms, this macro regime describes an environment where growth momentum is decelerating at 0.1904, while inflation momentum is accelerating at 0.00009. A mild stagflationary mix of softer activity and gently firming price pressure in the data. Coherence score is moderate, and the same confirmation score of 16 out of 21 series sits in the middle of the framework's confidence bands. By our framework's reckoning of comparable historical conditions, regimes with a confirmation score in this range held in roughly 41% of cases over rolling 3-month windows, with the most frequently observed next state being an acceleration regime, a characterization of past patterns only. Compared to last week's reading, confirmation has stepped up from 14 to 16 aligned series, telling us more pieces of the 21 series map now agree on this mild, stagflationary setup. Historically, environments like this have felt like grinding markets. Broad indexes often showed limited net progress, while real assets and defensives carried more of the load. A record of past behavior rather than guidance. Let's walk through 4 signals that sit inside this picture. First, the Treasury yield curve. The 2-year note is around 4.21%, the 10-year around 4.56%, and the 30-year near 5.06%. with the 10-year minus 2-year spread modestly positive. Markets watch these levels because they summarize how policy expectations and long-term inflation and growth views map into actual borrowing costs. The question this raises is whether investors see this rate mix as an acceptable backdrop for the amount of duration or leverage they are carrying. In our framework's reading of comparable periods, this roughly coincided with inflation composites that had already begun to firm, and bond total returns that were mixed over the following quarter, a record of past behavior, not a forecast. What would challenge this read is a decisive move either lower in long yields or higher in front-end rates that breaks today's mild steepening. Second, labor conditions via non-farm payrolls and credit spreads. The labor signal in the regime engine is red on momentum, defined quantitatively by payroll growth slowing and job creation no longer compounding at prior rates, even though absolute employment remains high. Markets watch payrolls because they anchor household income and default risk. The real-world question is whether a slower hiring pace changes how much exposure or liquidity feels prudent. In our framework's reading of comparable periods, this roughly coincided with a gradual widening in high-yield credit spreads within a few months, a historical pattern, not a projection. A renewed acceleration in payrolls or a tightening in credit spreads would challenge that interpretation. Third, the volatility complex across equities and bonds. The Equity Volatility Index sits near 17 with a small daily rise. The Volatility of Volatility Index is just under 100, and the bond volatility gauge is subdued in historical percentile terms. Momentum here is yellow, defined mathematically as normal level but drifting higher rather than deeply calm or stressed. Markets watch these measures because they translate uncertainty into option pricing and risk budgets. The question for participants is whether modestly rising volatility changes how much risk, patience, or position size feels comfortable. In our framework's reading of comparable periods, this roughly coincided with sideways to choppy equity performance over the next several weeks. Again, a record of past behavior, not a forecast. A decisive drop in volatility or a sharp spike above recent percentiles would challenge this signal. Fourth, sector behavior across equities and real assets. Technology and industrials are under pressure, while energy, utilities, financials, and real estate are holding firmer. Gold futures are higher overnight, even as the main gold equity fund is consolidating, and crude oil is trading in the low 80s with a notable daily gain. Momentum here is green for energy and defensives, mathematically defined as positive moves outperforming broad indexes, and red for high beta growth sectors. Markets watch this rotation because it hints at where investors are comfortable keeping capital at work when growth and inflation signals look mixed. The key question is whether this tilt changes how much cyclical versus defensive exposure feels appropriate. In our framework's reading of comparable periods, this roughly coincided with more stable performance from cash flow heavy and real asset groups over the subsequent weeks, a record of past behavior, not a roadmap. A reverse rotation back into technology and cyclicals would challenge that read. The conditional map the engine tracks adds two important if-then statements around this regime. If the 10-year Treasury yield crosses 4.45% and holds that level for 5 consecutive sessions, in our framework's reading, inflation composites showed acceleration in roughly 9 of 11 comparable conditions. A historical characterization, not a forecast. In a stagflation mild regime, that kind of move would mathematically strengthen the record of transitions toward more pronounced acceleration in price measures. If the Fear and Greed Index drops below 15 and holds for 5 consecutive sessions, in our framework's reading, the confirmation score deteriorated in roughly 7 of 9 comparable conditions. Again, a historical pattern. Under a mild stagflation red, that would mark a shift into a more fragile confidence zone. The map is live. These conditions are being monitored daily across all 21 series. Atlas is the automated rules-based engine inside Given Analytics. It does two things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed 4-layer mathematical framework, price structure, rate of change, risk regime, and market participation across 407 liquid symbols every trading day. When all 4 layers agree on a symbol, Atlas records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the 4 layers line up, not a trade. These are time-stamped model readings, logged for members to study. The environment view and the condition log sit side by side inside Atlas. They are separate outputs. The regime does not pick the symbols, the 4 layers do. Members use Atlas to study how the framework has recorded conditions across prior environments, as historical behavior, not as trade selection. Atlas runs the framework. You study the outputs and environment. You decide what to do next. All of this is framed as potential, educational, a way to study how the math has behaved, not a set of instructions. The morning brief is the public surface. The live Atlas dashboard shows the full 21 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the Atlas outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com.